Ladies and gentlemen, good day and welcome to GMM Pfaudler Limited Q3 FY22 earnings conference call. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Priyanka Daga from GMM Pfaudler Limited. Thank you, and over to you, ma'am.
Thank you, Aman. Good evening, ladies and gentlemen. A very warm welcome to all of you into the Q3 FY22 earnings call of GMM Pfaudler Limited. The earnings call presentation was updated on the stock exchange and available on our website as well. Hope all of you had a chance to go through it. From the management, we have with us our Managing Director, Mr. Tarak Patel, our CEO of India Business, Mr. Aseem Joshi, our CFO of India Business, Mr. Manish Poddar, our CFO of International Business, Mr. Alexander Pompner, and Company Secretary and Compliance Officer, Ms. Mittal Mehta. We'll give you a brief overview of the performance of the company, after which we will get into Q&A. Before we begin with the overview, a brief disclaimer. The presentation which we have uploaded on the stock exchange and our website today, including our call discussions that will happen now, contains or may have certain forward-looking statements concerning our business prospects and profitability, which are subject to several risks and uncertainties, and the actual results could materially differ from those in such forward-looking statements. I now hand over the call to Mr. Patel to provide an overview of the quarter performance. Over to you, Tarak.
Thank you, Priyanka. Good evening, everybody, and good afternoon, good morning to people dialing from other parts of the world. This has been another solid quarter for us, driven by strong execution in both our international as well as our India business. Order intake continues to remain positive, with our order backlog at an all-time high across the globe. Our key industry segments, chemical and pharmaceuticals, continue to invest in new capacity, and our outlook remains positive. Chemical, specialty and agrochemical investments continue to drive growth, with large projects planned in the coming months. The China Plus One strategy, backward integration to reduce raw material volatility, and the CRAMS opportunity will continue to drive investment in these sectors. Further, pharma continues to remain a bit subdued. However, with the new government initiatives like PLI, we may see investments in the coming quarters. Let me now take you through the business performance, starting with our international business. As I mentioned earlier, we have shown a strong execution in the international business for the third successive quarter. This goes to show that our focus, operational excellence strategy, and integration efforts have started paying off. It is now clear that some of the underperforming units, namely Germany and China, have turned around and will continue to perform well. We have managed to significantly grow the international business's revenue, which is up 25% over the last 9 months on a comparable basis. On the profitability front, we have also improved profitability by 52%, and our EBITDA margin has increased from 8.5% to 10.3% over the last 9 months, again on a comparable basis. When we bought Pfaudler International, it was an EBITDA margin of about 7.5%, so this is definitely a significant improvement. This is a fantastic achievement and will go a long way in building confidence and momentum in the international business, which we acquired only a year ago. Order intake in the international business continues to remain strong, with an increase of around 46% for 9 months. The backlog of the international business is currently at an all-time high at rupees 1,589 crores, which is around 53% higher than the previous year. Some of the order highlights during the quarter: we received an order from South Korea for acid recovery in the range of $10 million. We received another filtration and drying order in Europe for $6 million. The Mavag backlog currently stands at $38 million. And then we received some systems orders from France for about 3 million euros as well. Now talking about our India business, again, the execution across our product lines has been quite strong. Revenue is up 30% and EBITDA is up 31% on a 9-month basis. However, higher input costs and investment in our new facilities which are basically Vatva and Hyderabad, have impacted profitability in this quarter. On the input cost front, we were enjoying the benefits of steel prices and steel plates that were procured at lower prices a few quarters earlier. However, now we are consuming plates procured at much higher rates. We were also hit by a one-time increase in gas prices in the Gujarat during this quarter. On the ramp-up cost of Vatva and Hyderabad, these are essential investments to scale up the operations and for our new areas of growth. And as revenues grow, we will see the benefits flowing through. We expect the current profitability to continue for the next couple of quarters. However, we are beginning to see a commodity prices taper, and we may see the benefits flowing through to our bottom line. Order intake in India business continues to remain strong with an increase of around 39% for 9 months. The backlog of India business is currently also at an all-time high of rupees 568 crores, which is around 46% higher than the previous year. Some order highlights during the quarter. We got our first micro-reactor order from a pharmaceutical company, a large glass-lined order from Bangladesh, a large Mixion order, and then we got a large heavy engineering order in the tune of 50 crores, which will really help us push and grow the heavy engineering business. Momentum on the integration front also continues with the launch of Intersteel 85000 in India. We have now installed 11 Intersteels, and we now expect more orders in the near future. The new furnace in Brazil is operational. The one in Hyderabad will be operational in about 2 weeks. We expect the new furnace in Gujarat to be operational by June 2022. Further, under value sourcing, we regularly supply components made in India to our European entities. We've also recently started a stock and sale program where we will stock vessels in Europe. The first order for these equipment, 24 number of equipment, have already been placed, and the manufacturing has already started. The group's new brand architecture is also ready, and we will be launching that shortly. In spite of the challenges faced during the quarter, the power shortage, the energy cost increases in Europe, the higher input costs in India, we have still managed to grow both revenue and profitability on a year-on-year basis. The credit goes to the multiple teams across the company whose hard work and determination has led to this performance. We are confident that we continue with this performance and we will end the year on a high note. I now hand over to our CFO, Manish, to take you through the financial performance.
Thank you, Tarak. Good evening, everyone. So let's start with the consolidated numbers. During Q3 of FY22, on a YOY basis, the revenue increased 218% to 642 crores, and we clocked an EBITDA of 82 crores versus 42 crores in the corresponding previous year. Profit after tax, excluding the non-cash PPA impact, also increased 85% YOY to 43 crores versus 23 crores last year. On a 9-month basis, both top line and bottom line exhibited similar growth. For standalone business, during the Q3 FY22, on a YOY basis, revenue increased 26% to 209 crores with a flat EBITDA of 38 crores. PAT was down 12% YOY to 12 crores. Lower margins during the quarter were a function of a few things. One, the full cost impact of higher steel prices during the quarter. So the weighted average cost of steel plate was lower during the previous quarter, and as we consumed the initial quantity on account of the past inventory of lower plate. But as we progress through the year, the full impact of the new prices in the inventory has come in, therefore impacting the material cost. Higher gas prices during the quarter also impacted the margins. We had a one-time impact of some 2.5 crore rupees on the higher gas cost. Similarly, the third piece is on the ramp-up with the higher admin costs at Vatva to enable future growth. We are adding resources in these facilities, cost of which is not yet fully absorbed due to the lower scale of operation. This is visible in the employee benefit expenses, labor costs, and other expenses. On a 9-month basis, top line grew 30% YOY to 586 crores, and EBITDA increased 31% YOY to 133 crores. PAT stood at 75 crores with a 17% growth. Annualized EPS, if we adjust for PPA, stands at 96 rupees per share, YTD December, this is YTD December performance on an annualized basis, versus 66 rupees per share in FY21. Kindly note this excludes the share of the minority interest. Currently, only 54% of the Pfaudler International profits are being included in this EPS. If we take that at 100%, another 20 rupees can be added on the EPS. Also, we are happy to inform that CRISIL has reaffirmed our rating to AA- with a stable outlook, which is equivalent to a low risk. This was done today morning only. Priyanka, back to you.
Thank you, Manish. With that, I would like to now open the call for questions. Happy to answer any questions that you may have. Thank you.
Thank you very much. Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles.
Good, Sandeep.
The first question is from the line of Salil Desai from Marcellus Investment Managers. Please go ahead.
Hi, Tarak, Manish, Priyanka, and Alexander. One question I had, maybe Alexander can help answering, is can you give us some idea on how the working capital cycle typically is in the international business, and if you could break it up, into the 3-4 main components of inventory, receivables, payables, and if customer advances are a significant part of it.
So Salil, if you recall in Q2, which is H1 performance, we had shared a detailed presentation with regard to the working capital cycle, including the net of advances numbers. There's not much of a change with regard to those numbers over these 3 months. From a working capital perspective, the DSOs stand at something like 43 days, and DIOs, net of excluding advances, also stand at something like 20 to 23 days. So maybe Alex is on the line, right? So Alex, you would like to respond to this question?
Specifically on the international business, right?
Specifically on the international business,
yeah. I could confirm what Manish just said, that in fact there's not much fluctuation in our working capital. Nevertheless, we launched several improvement measures, and therefore I think to the guidance we gave in the presentation last year, we see improvement. So long term, and to give you an idea regarding values, and I'm talking now in USD, we are inventory-wise in a range of, let's say, 65 million. We have receivables of in the range 32 million, and I think these are the key you are looking for. And if you payables, we are a little bit lower than receivables in the area of close to 30 million. Does it help?
Yes, thank you very much.
Thank you. Next question is from the line of Sandeep Tulsian from JM Financial. Please go ahead.
Yeah, hi, good evening, everyone. Firstly, congratulations on a decent set of numbers given the cost pressures that we have seen. Firstly, if I would like to check if you'd like to give a guidance for annual growth for next year, given the kind of order inflow ramp up that we have seen in the first 9-month period. What kind of growth can we expect in India for the international as well as Mavag business separately, if you can guide for?
Right. So I think, Sandeep, India continues, we grow around 25% plus a year in India. This year in Europe as well, we are growing at about 25%. We are currently working on, and I had spoken earlier about the strategy meet that was planned in the December, which got postponed. We do plan to come out with guidance, revised guidance in terms of both revenue and profitability for the next few years. Even in terms of, what we plan to do and what are the different areas where we plan to grow and how we plan to grow. So a little bit more granular, a little bit more in detail. I would just request that, just hang in there for a month or two. We are kind of working on something, and we'll come back with something that's a little bit more concrete and structured rather than giving you a number right now. But I think I am comfortable to say that on a yearly basis, even though we've seen a decrease in profitability here in India, we pretty much are confident that we will maintain a similar level of profitability. So on a full year basis, we'll still be around the 20% mark, the EBITDA mark. And as you said, Pfaudler has done extremely well. They are now at a 10% mark as well. So those two numbers look very, very possible. And in terms of the backlog that we have and the execution that is happening, I'm quite confident that we can end the year on a good note.
All right. Second question is pertaining to strong inflows. Of course, you gave some color where these inflows are coming from. Two things. One is, when we had given the acquisition of...
Sorry, your voice is breaking, Tulsian.
Sorry, Sandeep, can you say that again? We lost you for a second.
Yeah. My question was pertaining the growth drivers for the international inflows. When we had acquired Pfaudler International business, we had guided for a 5-6% kind of a long-term CAGR where the industry grows at. But the inflows seem to be indicating the growth is much higher than that. So if you can give more color, why such a sudden jump in the inflows, what we are seeing right now, and what could be a sustainable growth going forward?
I think from an overall standpoint, obviously when we acquired Pfaudler, we acquired at a good time when obviously business was, not doing that well. We managed to very quickly bring in order intake and, got the factories up and running quickly. So I think one of the areas that we are seeing this improvement coming is both China and Germany have now reached and pretty much operating on full capacity, right? I mean, we are obviously looking at improving and increasing capacity and output, but these two factories were obviously not doing that well, and we were in the process of moving from an older facility to a newer facility. So I think these two facilities definitely add to the revenue improvement. Also, many of the strategic initiatives like, sourcing from India, as well as new products like acid recovery, Interseal, those have done quite well. And then lastly, the U.S. market has done quite well. So Brazil and the U.S. both have done quite well. So that's why probably we're seeing a double-digit growth rate of an international business, which obviously people thought would be growing at a much slower rate. And I mean, to be honest with you, this quarter, the international business kind of makes up for the slower growth rates here in India. So all in all, we've been quite happy that acquiring this global business mitigates some of the risks that we had with being only an India-centric company. Alex, do you want to add something to this?
No, this is fully correct. And I think we gave as guidance last year the high single-digit growth. Currently, we significantly overachieve, and we overachieve in all regions. Europe is doing strong, and China, we already said after the setup of the entity, is growing fast on revenue and order intake size, but as well as the US. Nevertheless, what should be considered, we are doing well on the technology order inside and the systems, which are big projects. However, the service business, which we also have strong in our international business, this is currently lacking. It's growing, but it's by far not growing as fast as the technology business. So there we still have improvement potential also from the margin side. Regarding the profitability, already what Tarak mentioned, Germany is one of the key growth driver. The turnaround of the site is more or less completed, and therefore see a big jump in profitability and also expect further improvement going forward.
What should be the sustainable growth here going forward? This year, we agree the growth was good. Going forward, should it go back to that mid-single-digit growth or?
I think, let me say, we keep the outlook that we gave, and as Tarak mentioned before, come with a new guidance in the coming months. And I think we would like to leave it there and do not want to now adjust already our growth projections.
Got it. And one last question, if I may squeeze in. On the South Asia business, 2 quarters back, you had given an update that there would be introduction of products you don't have a major presence because of the pricing differential of glass-lined reactors that Pfaudler makes in those markets. So if you can give an update on that and what is the progress on that? Have you got any orders from that region?
Yeah, so we've had about 3 large wins in Southeast Asia. We've had a couple of systems orders and some glass-lined business as well, so that's progressing. Obviously, we would have wished that we could have traveled into these Southeast Asian countries a little bit more. Unfortunately, the borders are closed and they're quite strict about it. But again, it's a long-term strategy of ours to grow this business. It will take some time, but we are definitely making some headway.
Okay. All right. Thank you so much.
Thank you.
Thank you. Before we take the next question, I'd like to remind our participants to limit a question to 2 per participant. If time permits, you may join the queue for any follow-up. Our next question is from the line of Utsav Mehta from Edelweiss AMC. Please go ahead. Utsav,
hello.
Please unmute your line and proceed.
Yeah, sorry. Hi. Am I audible now?
Yes.
Yeah, Utsav, go ahead.
Yeah. Hi. So, Tarak, thanks for taking my questions. I wanted to understand our gross margins a bit better because if I recall correctly, last quarter, we said that, I mean, you've seen the worst of the steel price inflation probably 2 or 3 quarters ago, right? And last quarter, we said that now we've repriced most of our new orders that have been coming in. I'm also looking at international where gross margins have expanded, whereas in India, they've contracted. So if you could just help me understand the dynamics behind all of this.
Yeah, so Utsav, if I may take that and maybe Tarak can then supplement on that. So you're right. We had taken price increases earlier in the 3-4 quarters back as well. So what has happened is there is a lag of where the price increase benefit came in immediately, rather relatively earlier, and the full impact of the price increase of the material has come maybe a couple of quarters later. So if, for example, we were buying steel at say 60 rupees a kg, and over a period of time it increased to 80 rupees a kg. So initial quarters, your weighted average would have been something like 70. Now, as 60 rupees stock gets depleted, you actually come up and you come to a realistic picture of 80. Now, as the prices go taper down in hopefully in near future, the margins should improve there.
So I think just one point to add here, the only difference in strategy in terms of procuring steel plates, when the prices are lower, we procure large quantities. We procure maybe quarters worth of plates at one time. But now with the volatility in the steel prices and the higher steel prices, we kind of only procure what we really need. So as soon as we're seeing this coming down, we try and mitigate or reduce the time frame or the lag between actual using of these plates so that we get the benefit as soon as possible. Go ahead.
And similarly, if you see a Vatva facility, now obviously at the current run rate, the full cost absorption is also not happening, whether you talk about labor costs or the overheads as well. So the overall profitability also gets impacted. Although material cost, of course, we know from a weight perspective, heavy engineering per se is not as profitable as a glass line equipment business.
Understood. The second part of my question was, then how come, I mean, will we see similar dynamic play out in international where right now we're enjoying some benefits which could taper off later?
No. So I think when you look at the international business, you look at 3 major areas. One is obviously the U.S. The U.S. has not been affected at all by energy or significant, the price of steel has gone up, but they've been quite able, they have been able to pass it on quite well. However, UK and Germany have been hit by higher energy costs. Hopefully those will start reducing. China had a short-term impact of shortage of power, but that has been fixed and did not have a big impact at all. But going forward, we believe that the 9 to 10% EBIT margin range is still possible for the international business. We don't see a significant impact on material costs impacting because the orders that have been taken with these new prices in mind. Alex, you want to add something here?
No. In general, I can confirm that this above 10% margin is definitely something we should also see the coming months. We feel, especially the energy cost in Europe, what Tarak mentioned, and this will be has an impact on margins now shortly, but definitely we will remain above 10% with further upside potential, especially with the growth potential in our service business.
And also, if I may just add one more thing, kindly appreciate India business is heavily dependent upon OE business, the original equipment business, and the glass line business. So the services portion, unfortunately, is a very much smaller 5-7% of the total business per se. So therefore, there's a full flow impact of material on the India P&L. Vis-a-vis when we go to the international business, they have a 45% of services business, so which doesn't really get impacted much by the raw material prices.
But I think just to add to this, I think more from a future and what we are planning to do to mitigate these increases, we are actively looking at cost reduction measures. We are looking at internal controls as well as renegotiating contracts with our suppliers to make sure that we have much more efficient the procurement. So that's something we're working on already. On top of that, we're trying to increase our exports as well as our service components because obviously they are more profitable. So we have a clear plan in terms of how do we look at increasing profitability, and this is all internal controls. And on top of that, if you see material prices taper off and come down, then that is the additional benefit that will flow through. On the second front, when the two facilities, mainly Vatva and Hyderabad, have significant improvement in revenues next year because they will significantly grow, you will see some fixed cost absorption there, which will also help profitability. So I think we are in a strong position. I don't think there's anything structurally wrong with the business that has resulted in lower margins. I think this is a 1 or 2 quarter event which we really could not control, especially the gas increase prices is a one-time price increase, but we will do our best to try and mitigate some of these cost increases so that we kind of maintain and improve profitability.
Understood. Appreciate the detailed answer, Tarak. I'll just close off with just asking for the debt and the cash number on a both consolidated and standalone basis at the end of the quarter.
So debt, there is no fresh debt. The partial repayments of debt have happened. So December end, we stand at 525 crores of debt. And Concall, and 300 crores of cash. And on India basis, we have some 142 crores of debt included in this 525 number.
Can you just repeat the standard, the Concall debt number, please? I just missed that.
Concall debt number is 525 crores. Cash in hand is cash equivalents is 300 crores.
Understood. Thank you so much for your time. I appreciate it.
Thank you. Our next question is from the line of Ravi Naredi from Naredi Investments. Please go ahead.
Thank you very much, Tarak Patel-ji. You are doing exceptionally well. My point is, this order backlog 2067 crore and international order book 1589, so total order book is 3500, right?
No. So 2067, the Naredi ji includes 15 odd of the international business. Total is 2067.
Okay. That was confusion, so I want to clear it. And sir, why international margin is low versus Indian margin?
I think the international business historically has been lower because their labor costs and employee costs are definitely much higher than in India. But what we are trying to do here is to really increase the size and scale. So with the same number of employee base, if we can grow the revenue 2 or 3 times, then you will see the employee cost as a percentage of revenue come down. And just to give you an example, when we bought our Swiss company in 2008, it had 38 employees and it was doing a revenue of $7 million. Today also it has 38 employees but does a revenue of $25 million, right? So if we can double or triple the revenue of the international business, then the employee cost will come down.
Right. Very intelligent thing. And capex plan for Q4 and financial year 23.
So there is no new capex plan. Like I mentioned, we have the Hyderabad furnace coming in the next 10-15 days. So that will be definitely a capacity boost for us. We also have a new furnace coming in Gujarat. This will come in to production sometime in June or July, which is going to also help us because it's a large furnace, 80,000 liters, will give us capacity both for the Indian market but also to export to our parent organization. So it will be a very timely capex that we will add. Besides that, there is no other significant capex that is planned for this financial year. Next year, we will probably think about it a little bit more in detail, but I don't see significant capex next year. I think next year we will probably use all the capex that we have made and all the investments that we made and really try and grow the revenue.
Thank you very much. Thank you very much.
Thank you.
All the best.
Thank you. Our next question is from the line of Srinivas from Rockford Consultancy. Please go ahead.
Good evening, all of you. Tarak bhai, this question is for you. One of the interviews you have mentioned that there is a large order from US. Whether it is included in this result or whether it will be factored in March quarter?
No, it will be all shipment will happen in Q4. There is no shipment that has happened this quarter. The US order is going to be shipped in Q4 of the next, of this financial year. So you will see that playing through in Q4 and that and Q1 a little bit. But they have also increased the quantities in that order. So they have actually added more quantities. So that US order will continue into Q2 and maybe Q3 also. And yeah, that's a good order, and that will definitely help improve profitability not only in India but also in the US business because the order was taken by the US organization.
Okay. My second question is whether we have shifted entire production of proprietary products to our Vatva factory or
no, so proprietary products remains in Karamsad predominantly, 90% of it is, but we had moved some small equipment that, we needed extra capacity and Vatva had it, but I think as a long-term strategy, Vatva will be pure HE and proprietary products will be made in Karamsad.
Okay, thank you. That's all.
Thank you.
Thank you. Our next question is from the line of Vivek Gautam from GS Investments. Please go ahead.
Yes, sir. Sir, I just wanted to know about the sort of industry dynamic question. Has India cemented the place of becoming the international chemical manufacturing hub for the world, or are there still threats from China and other countries? And what about the concerns on the environment, pollution, and the fire incidents which happen?
So I would not say that we have taken over the leadership position, but I can definitely say that the chemical market in India is growing. There is new investment coming in. Today, during the board meeting, we had made a presentation and we had listed out all the companies that are planning investments over the next maybe 1 or 2 years, and there's significant investment coming. Many of you know also about the recent IPOs and people and companies that have raised funds, and these funds will be reinvested. Like I mentioned, there's a China Plus One strategy, there's a contract manufacturing strategy, there's also backward integration to reduce dependency and volatility of products that people buy. So all in all, I think the India chemical industry does look quite positive, and we have, I could count on the top of my head the number of inquiries and new projects planned in the next 2 to 3 months, and they're quite large and they're quite big. So I don't see an issue there. But I still believe that China is going to revive. China will come back. But today, I think there is definitely a reduction in global supply of chemicals. I think during the pandemic, there were many companies that downsized and shut down. And today you see an increase in higher the chemical prices only because the supply is limited, but the demand is still high. But I would see over the next few quarters, people investing and building capacity.
The concerns on the pollution and the fire incident, unfortunately, which is increasing in India, what impact?
Yeah, so I think that's something that could work well for us. I think one is when safety norms kick in and people want to set up good manufacturing facilities, then they try and buy equipment and technology from reputed companies. So that could be definitely a benefit for us. The other area that we could add value is in terms of asset recovery, right? So asset recovery is definitely something that companies will become much more conscious about because it's becoming an environmental issue. There were recent examples where people had disposed of chemicals and obviously they were not disposed of correctly. So in the future, people will look at kind of, cleaning up these products within their facilities rather than just kind of giving it to a third party, which in turn could spur new business for us when it comes to asset recovery.
And how are we placed in AF&D filters, sir, and what is the opportunity size over there? Internationally and internationally, domestically, and our recent international acquisition is helping us in sale of more sale of our product through cross-selling?
Yeah, so ANFD in India, we are definitely not a big player. We focus on really the high-end market of spherical dryers and kind of, clean ANFDs and sterile ANFDs and things like that, containment applications. But we are a big supplier to our Swiss company, which has currently a backlog of close to 38-40 million Swiss francs. So they are nearly booked out for 2 years. And the focus there is obviously that the European business is quite strong, but we want to break through in the US market. So one of the focuses now is to grow the Mavag F&D business line in the US market. The good thing about the US market, it is ASME and it is something that GMM can supply directly. So most of the equipment that we will end up selling in the US market will be manufactured here in India.
How is the opportunity size for the ANFD filters, sir? India as well as abroad?
I would say that I don't have the numbers at the top of my head, but the Indian market could be around maybe 300 crore mark, I would say. And then in Europe, maybe about $60-70 million and maybe another $30 million in the US. And these are just, kind of broad level numbers. So don't hold me to them, but this is probably a thumb rule that I can give you.
Excellent work you're doing, sir. Keep up the good work, sir. Thank you very much.
Thank you.
Thank you. Our next question is from the line of Ronan Dalal from Museum Capital. Please go ahead.
Yeah. Hi. Good evening, sir. Most of my questions have been answered, but I just wanted to understand that you had mentioned last quarter about the chemical orders which were doing well, and you touched upon that in the previous participant's question. But you also mentioned that the larger pharma companies are not really participating in the orders as much, and it's just the smaller pharma companies. Could you give us a sense of how you see the demand dynamics evolving from a near-term perspective? What are your thoughts, and also from a little longer term, maybe a 3-year perspective?
So I know of our big pharma customers, they have been pretty subdued in terms of investments. Divi's, for example, has kind of held any kind of capex in the short term. But what we are seeing now is definitely people taking interest in terms of the PLI scheme. So we've seen a large inquiry coming for fermentation reactors from Hyderabad, where they will make PENG. So that is really driving, and there's a list of I think about 10 or 12 different companies who've signed up for this, kind of investment through the PLI scheme. Again, like I mentioned to you, the smaller guys have been investing. The guys who are, kind of supplying into the bigger pharma guys have kind of doubled their capacity and improving or increased their products to that. But again, pharma is something that has not really taken a lot of aggressive investments recently, but I personally think that the next couple of quarters you will see something. I think Ashok or Aseem, do you want to add something here?
No, I think you've covered.
Ashok, something?
The pharma business is, like Tarak mentioned, subdued. But we are expecting cycle of capex in the big pharmas also to take off soon. So we know that Divi's have plans to sort of start the expansion of API products. Most of them are now concentrating on the production after the API, so in the finished product, and they're not gone back to API. But we think that thing will change, and we'll start seeing traction in the
So they've all acquired land and they have huge parcels of land. So I know that even Aurobindo has, for this Penji, 300 acres lined up. They're starting the civil activities now. They're floating the inquiries. Even the Divi's has Unit 3 in Kakinada kind of thought about, but they haven't actually gone down to actually releasing orders or having anything concrete. But we do expect something to come in the next financial year.
So the PLI thing that he talked about, what he talked about was the fermenters, and apart from that, they also have PLI scheme for the key starting materials, which is not bio type of product, they're chemical products. So we'll start seeing action in that as well once the projects are formed up.
My follow-up is that so it's not impacting your schedules and your targets.
No, so in terms of current backlog, we are in a very strong position. We also know of large orders that are being planned in the next maybe 2 or 3 weeks. So, no, from a capacity standpoint, we have no problem in terms of, execution. We have enough of orders coming in. And, for us also what happens is when it's chemicals, the sizes are much bigger. So we have definitely a large backlog in the bigger sizes, which is 16,000 and 20,000 and higher. But pharma, once it starts picking up, you'll get much more of the smaller sizes, which we also need. So I think it'll be a good mix to have, but it's not affecting any short-term revenue or growth possibilities for us, no.
Sure. And just one comment from my side is that, just the meeting that you all had with the 46 key management personnel, we would like that, you can share that at the earliest. That's all.
So Ronil, we didn't actually have the meeting in person. We actually had to cancel it because of the third wave. We had an online town hall. But we will be sharing some kind of documentation. We are creating a new story for ourselves. Obviously 1 year of integration is completed. We can't keep integrating. I think the integration, the efforts will continue, but there's clear strategies around market share improvement, cost reduction, sourcing from India, new markets, M&A opportunities. I think we're going to put something down. We are already working on it. And I think over the next few months, we will be able to share something with the group that gives you a clear idea on where we want to be in the next 3 to 5 years.
Right. So can we expect this to be a much more advanced version of Project Apollo?
Yeah, I think so. I think it'll be more granular in nature. So I think, we can't keep harping about integration. I think integration is done and dusted. We have a good team. These processes are now set. We don't really need to. It's like pretty much on autopilot. We'll push it, obviously, we'll review it. But there has to be other growth areas. There has to be other areas of improving profitability, adding new technologies and products. So all those things will fall into that document, which will be shared with the group.
Sure. Thanks, Tarak and team, and all the very best.
Thank you, Ron. Thank you.
Thank you. A reminder to our participants, please press star and 1 if you wish to ask a question. Our next question is from the line of P. Sachadev from Albatross Capital. Please go ahead.
Yeah, hi, Tarak and the team. Congratulations on a great set of numbers in a challenging cost environment. Most of my questions have been answered. Just wanted some rough estimate on the capacity utilization across various plants at Pfaudler Inc.
So I think maybe Alex would be in a better position to answer that. Alex, what is the current capacity utilization around our main facilities, namely Germany, Italy, China, US, and Brazil?
They are highly utilized. We have to say, so we grow so fast, and we grow faster than originally anticipated. So yes, they are at the high end of utilization.
Yeah, so I think the problem is not having capacity right now. That's why we are adding capacity in Brazil. We are also adding some capacity and new equipment in the US. So again, also from a standpoint of motivating the local teams, I think we've not invested, and Pfaudler has not invested in these facilities for quite some time. So people are quite motivated. Germany and Italy obviously are brand new facilities, and China is as well. But I think we all would prefer that at some point we increase the output. But right now the focus is really stabilize the business and ship out as much as possible. And obviously Q4 is an important quarter for us. So the focus is really on execution, and then we'll probably spend some time looking at operational improvements and how we can kind of get more output from the same capacity.
Okay, so would really appreciate if you could put a statement or a slide, on the optimum capacity, on the optimum turnover that you can achieve, post this capacity expansion, as and when you come out with a revised vision guidance.
Sure. So we can do that, and I think it will be helpful also. We worked out some numbers also across for our Vatva facility as well, which is a new unit, Hyderabad, and then for the rest of the company. We'll try and put something together as part of the document where we are and where we can go with the current setup.
Great. All the best.
Thanks, Pfaudler.
Thank you. The next question is from the line of Harshal Shetia from AUM Fund Advisory.
Hi, sir. Congratulations on a good set of numbers. So going ahead, I have two questions. Firstly, has our Vatva facility started?
Sorry, we missed that. Harshal, we lost you.
Yeah. Has our Vatva facility started?
Yeah, so Vatva facility has started. We have also moved quite a bit of the orders to Vatva. There's some work that's happening in Karamsad and some in Vatva, but I think about 80% of the work has now shifted to Vatva. And
we started the operation partially in Q1 itself this financial year, and both the HEs being run this year in both the operations, both the places, one at Karamsad and at Vatva. It's a transition period. I think by end of Q1, we should be in good position to completely transition into Vatva for HE business.
Okay, so can we say that Vatva should be, at full capacity by Q1 or maximum Q2 of 23?
Okay, so I'll put it that entire HE production for GMM Pfaudler will happen through Vatva in Q2, starting Q2. However, achieving full capacity will obviously take time because as we know, to reach 400-450 crores of turnover will obviously not happen in the next financial year for sure. Aseem, you want to add something?
Yeah, I'll just add. I think, as we've exercised our Vatva facility, the factory is ramping up. And that will continue to happen in the next financial year after we transfer completely to Vatva. So, Q3, Q4 will continue to ramp up, and I think the following financial year is when we expect to be at full capacity.
But we do have some overall thoughts around what the actual tonnage this facility can ship out. We've done some internal calculations. We also know about what is the right mix between carbon steel, stainless steel, and exotic materials, so we can maximize revenues and profitability. So we are quite aware and conscious of that. And then on top of that, can we improve and have any the operational improvements that can further improve this business? But all in all, I think Vatva will really show its true colors next year. The order backlog remains very strong, and the only thing that we really need to focus on next year is the execution part of it.
Okay. Second question, sir, I had was, we always plan of, making India the whole manufacturing base and shipping out the equipment globally across all our facilities. So, looking at the freight cost environment and, the way the prices have run up like dramatically high. So how do we, counter these stuff? And are we actually, as of today, shipping out products from India to, other countries?
So we are, and most of the contracts that we have, all of the contracts that we have are mainly ex-works, so that, the customers will end up paying for the shipping. So the entire US order, for example, is ex-work, and at the time when the equipment are ready for shipment, we will get a quotation from the local supplier, the shipment guy, and then we will give it to the customer, and then he will directly deal with them. For our internal consumption, for our internal transfer, yes, this will be an issue, but again, we have time, and in spite of the higher logistics cost, there's enough of benefit of sourcing from India. So the landed cost, after paying the higher logistic prices, it's still very lucrative and very profitable.
So actually, just to
Sorry, and I'll just add one thing to what Tarak said. Ultimately, these higher logistics costs are transitory in nature. In about 6 months to a year, we would expect that these would settle down. And so for us, this is a long-term strategy that we think will work out for us well.
Okay. And, follow up on the same. So, are we seeing any delay in orders of, picking up from the Indian facilities by our global customers?
No, I think in most cases, they are actually pushing us to kind of ship faster. So in spite of the US, the order, for example, is on a fast track, the project, and we have regular reviews, and they would be more than happy to pick it up even before schedule. So I think most of these plans have been planned. There is no slowdown in terms of customers wanting the facility, the equipment. They would rather have it quicker than later.
Okay. And so one more if I can. Are we seeing people, better margins from global customers compared to our Indian clients?
So export orders are always more lucrative, Harshil, compared to the Indian market. The Indian market is a good market, is a volume-based market. Yes, export business gives us definitely higher margins.
Okay, sir. Thank you.
Thank you. Next question is from the line of Rohit Ohri from Progressive Shares. Please go ahead.
Hi, Tarak and team. Your press release speaks about launches of some new products. What are these related to, and which segment are you looking at?
New product launches. Sorry. So yes. So we are obviously looking at Interseal in a big way. So that was a launch that was planned for last quarter, which we now did. We have installed 11 Interseals in India. They are working quite well. The customers are quite happy with them. So hopefully that will lead to further orders. The Interseal is something that we are quite focused on. We believe it's a great product, and hopefully that will add to both revenue and profitability. Plus it comes with obviously a good aftermarket business as well. So that's always a good thing to have. We also have acid recovery. Again, that is something that we've been working on. We did get a large order. There are few plans for Indian companies to set up acid recovery plants. We are actively pursuing those opportunities. And again, acid recovery plants are built around last time equipment. So it's a natural kind of complementary product for us. So these are the two main areas that we are focusing on here in India.
Okay. You seem to be expanding the sectoral bandwidth. So any thoughts as to, do you see any opportunities in green hydrogen and related equipment manufacturing?
So all good things to think about. I don't think we will say no or yes to any of them. I think there are definitely opportunities available, but I think we have to be a little bit careful in terms of how we can link it back to our product and what our strengths are, right? So yes, we are looking at different things right now, and if there's something that obviously would be something futuristic but could kind of come in quite handy, we will think about that. But I think currently we have enough on our plate, but we will keep thinking about and keep evaluating opportunities in the green energy segment, in having a ESG kind of a glass which is maybe which is more environmentally friendly and things like that.
Okay. My second question is related to the pension liabilities and the pension obligations. So what is the current obligation that we have on a yearly basis, if you can share that?
So pension liabilities, Manish.
Sorry. So pension liabilities, they currently stand at something like 450 crores outstanding as of 31st December. Not much of a movement, as we already have alluded that there is it's a fixed, closed pension plan. No new additions are happening. And what the movement primarily happens on account of actuarial valuations, and there is something like 25 plus years of payout period. So it's naturally progressing in that direction.
Okay, sir. Thank you. Thanks a lot.
Thank you. Our next question is from the line of Jason Sons from Ashika Stock Broking. Please go ahead.
Yes, sir. Thanks for taking my question. I would just want to know from the standalone order book, obviously it will be bifurcated into glass-lined, heavy engineering, and proprietary products. Could I have a segmental breakup of this, if possible, of your standalone order book?
Broadly, if you see, so GMM standalone, we have 570 crores of order backlog.
Right.
200 crores of GLE, 240 on account of HE, and PP is another 120.
Okay, 240 crores is HE and PP is 120, right? And the balance will be GLE.
200 is, GLE.
200 is GLE. Okay. And also, so in the other thing, in the international business, your order backlog is given. So basically, PFI order backlog, the total order backlog minus the PFI will be the Mavag order backlog. Is that right?
No. So 568 we said is GMM.
No. What I meant is, of course, in the international results, the order backlog stands at 1589 crores, and you have mentioned that 1281 is PFI. So the balance would be Mavag. That's what I meant.
307 or 308 is Mavag.
307 or 308 is Mavag. Okay, sure.
Right.
Okay, yeah. And just would want to understand. So I was just looking at the results, and yes, there is. I did read some comments on the purchase price allocation. So just would want to understand it a bit better, if possible. I understand there are some impacts, and they are non-cash. So how would we read into those?
Sorry, I think it's PPA. So PPA, okay. So PPA, if you recall, quarter 4 last year and Q1 this year, we had something like 46 crores per quarter of a PPA allocation, which is basically once you acquire a new business, there are intangibles being created, and the existing order book, the profitability thereon is not allowed to be routed through the P&L. Although the cash, the revenue comes to you, but the margins thereon does not accrue to the new management because that is assumed to be the efforts of the previous management, just to oversimplify it and from an accounting perspective. Okay. That number has substantially reduced, and now last quarter we had something like 18 or 19 crores of amortization of intangibles. This quarter we have 6.5 crores, and I think next quarter onwards we'll have something like 5.5 crores of amortization happening on a quarterly basis, and that will continue. So it is a non-cash item as we earlier alluded to. However, because we get a tax benefit on account of lower profitability, it net impacts us on the positive side from a net tax saving, and that's called positive cash impact.
Right. So that this is real cash flowing through, which you have mentioned in your release actually. That's right. Okay, sure. Okay. And and just one final question. I would just want to ask you. So basically, on a standalone basis, GMM has historically posted margins of around 24 to 25%, right? And obviously, after the Pfaudler acquisition, which has margins of around, it had margins of 7, now it's around 10, and your Mavag acquisition also has margins around 13 to 14%. So, would just want to know. I mean, obviously, domestically. In the filtration and drying equipment market, your positioning is not that strong. So just would want to understand what is your strategy going towards for strengthening your foothold in the filtration and drying equipment market, as well as when you go globally, what will drive margins further?
So I think in India, the filtration and drying market is a little bit commoditized, so I don't see margin profiles there to kind of be in line with what we plan to do as a group. So I think we don't want to compete in the low-end, low-margin, the F&D business. We definitely want to focus on the high-end, the spherical dryers, the sterile equipment, the containment facilities and things like that. We also have enough of backlog in Mavag where we are manufacturing components for them. 80% of the material that is manufactured from Mavag gets manufactured here in India, and then the final 20% of finishing and testing and instrumentation and automation gets done locally. So it's a win-win situation for us. So our focus today is really to cater to Mavag. On top of that, if we make a breakthrough in the U.S. market, all the production for the F&D business in the U.S. market will come from India. So from an F&D standpoint, our focus is definitely on exports, and I think that will continue. We don't want to really increase market share here and go after orders at low margin. As a group, obviously there are significant things that we are working on. We're working on sourcing components from India for European entities, which have started and is doing quite well. We regularly supply nozzles, steel plates, we supply other components that are then used by the European entity to reduce their costs. We also look at certain markets, lower price markets like Eastern Europe, Southeast Asia, Spain, some parts of South America where GMM Pfaudler will export directly. And then we have obviously cross-selling, so where we can bundle different products together. So these are all different areas that we are working on. And then lastly, on top of that, we also look at our internal cost structure, the efficiency improvements, operational excellence. So all these things are going on, and that's why you already see in a very short period of time, like I mentioned, 1 year since we acquired this company, and we've already shown a significant improvement in revenue and profitability. 25% growth of the international business, which is, as many of you had asked, that how do you and why do you want to acquire something which is growing in a 5 to 7% range? We have mentioned that there are opportunities available, and there's no reason why we can't really go and capture additional market share and grow or continue our growth journey. So I think from that standpoint, we are quite clear in terms of what we want to do. Some of these things take time. I think we have a good foothold, we have a good foundation, and we just need to build on it.
Sure. And so just one last, from a company understanding perspective, I would want to ask you. So obviously, GMM on a standalone basis has a proprietary products division, right? So is the main purpose of the division to supply, make equipment here and transport it back to Mavag? Is that how it plays out? I mean, just would want to understand, because so proprietary systems where you have here at Karamsad, it also has the same business what Mavag does.
So in proprietary products, we have filtration and drying. In filtration and drying, yes, about 70 to 80% of what we do is basically sent to Mavag, and these are basically the vessel body, the legs, the lanterns, the drive units, all that stuff gets made here locally. It gets sent there. Then Mavag will work on it. They will add all the wiring, the instrumentation. They will do the local testing, the FAT. The customer will come there. He will see the local equipment. So it's a kind of a win-win situation where the customer gets the best of both worlds. He gets obviously a cost advantage, but at the same time he gets completely European kind of finished equipment and a local European guarantee as well, and a local European face to which he can communicate with, right? So I think that is the strategy here. And F&D is one portion of PPE. Yes.
Thank you. Ladies and gentlemen, due to paucity of time, we'll be able to take one last question. That is from the line of Sandeep Tulsian from JM Financial. Please go ahead.
Yeah, hi. Thanks for taking up the follow-up. Just two questions on the capacity. Firstly, on the glassware capacity in India, in EU terms, where do we stand now? And after the current furnaces that you have mentioned will come online in Hyderabad as well as the Gujarat facility, where will it move to?
So, no, sorry, we didn't get that, Sandeep. Can you repeat? So EU capacity, I think we are currently at 2,400 here, about 400 odd there. We will give you new guidance for the next financial year with the new Hyderabad facility coming here. Obviously, it won't have a huge impact in Q4 because it will be a month and a half basically that we'll get to use it. But next year we should ramp up the EU capacity both by the investment in Hyderabad plus the new large furnace that will come into play in our Karamsad facility.
And for proprietary products, if one were to measure your capacity, How do you look at it, maybe in volumetric terms or absolute value terms?
I would say it will be around the 150 crore mark. I think that's something that, we can look at. I think anything over that, we would probably need to add a little bit of capacity. Like I did mention to you, we had space available in Vatva. If we still have that space available in the near term and we're not using it, then we could dedicate that to the proprietary product business. But again, the proprietary business has also done quite well. And like we were mentioning to you earlier, this entire fermentation piece, which is really, really important and which is really going to come up now in the next few quarters, all those agitators is something that we can build here. We have the expertise. These are very large agitators. Technology is very, very important because these are, what's the power rating, Ashok? 930 kilowatts. Yeah, so 930 kilowatt, right? So a lot of technology goes into power saving, shaft sizing, all those things are something. So if that kind of picks up, then we can use Vatva as well to make some of these agitators very large in size. But we've been talking to a lot of customers who are very, very interested in using our Mixion agitators for their fermentation application.
Okay. But if 150 crore is the capacity, you did 144 crore revenue in PP last year. So we don't have headroom to grow there, right?
No, I don't think we did 144. Did we do 144?
Yeah, we did 144. Last year we did 144. So I think this time we are like 120 already.
Okay.
So we should be.
So maybe around the 200. I was just saying a number. Yeah, 175, 200 could be there. But again, PP is an area that we are a little bit cautious with because one, unless we have the right margin profile, there's no use just expanding. We would rather expand where we have more control, where we are the market leader like glass line equipment. So that's like an easy low-hanging fruit for us. But if Mavag needs additional resources, which they will need at some point, then we will look at adding a little bit of more capacity here as well.
And obviously, Sandeep, you choose your battles. I think there's enough to do on the glass lining front, and then of course heavy engineering Vatva is coming up with Apollo project coming up. So you need to prioritize the growth areas.
Thank you. Before I hand over for closing, we have a few questions lined up in queue, and we will be taking one question from each participant. Our next question is from the line of Ritesh Vora from Mission Holdings. Please go ahead.
Hello, sir. Can you hear me?
Yeah. Yes, go ahead, Ritesh.
Yeah, you are in the. So I just want to look at 3, 4, 5 years down the line. I mean, not look the current order. When do you think this cycle turns around, and do you see a steady state of orders coming in even 3 years down the line? What do you see? Because you are the barometer of the chemical industries and pharmaceutical industry. Where do you see the growth coming up from which industry now, for next 2 to 3 years? Where do you see the orders coming up?
So good question. I think in the short term, there is definitely visibility both here and in the international markets. And international markets, when I say international markets, I say Europe and US. Both have been very, very active in the last 6 to 9 months. How long does it continue? I think probably another 6 months to a year, you will see investment. We have booked out, like I mentioned to you, $40 million in Mavag. All our Pfaudler units have close to 9 to 12 months of order backlog. So currently the industry cycle is definitely on the up, and there will be definitely investments coming in. What we do hope is that even if the market were to slow down at some point, there would be a high installed base of GMM Pfaudler or Pfaudler-made equipment. So that would obviously create a recurring business, a very sticky recurring business in aftermarket and parts. So that's something that we can always focus on. We also have diversified. So besides just glass line, we have filtration and drying, we have Mixion, we have heavy engineering. Some of these go into the same markets, but some of them also go into, let's say, oil and gas, petrochemicals. So there is risk mitigation strategy. And like I said, being a global company today, let's say if India were to slow down, there could be a resurgence of, let's say, investments in Thailand, for example, or let's say Africa. So you can always pick and choose, but again, we have to be careful that we don't over-create capacities. We keep continuously watching our cost. We don't have a very high fixed cost. And one of the things that we will look at doing over time as we move production to India is to probably look at rationalizing some manufacturing internationally. There are no plans of that right now, but as a good business strategy, this is something that we will have to look at. But again, I think for the current short-term period of about 3 years, I don't see too much problem with terms of business coming in.
And maybe if I may add, what Tarak mentioned, and it has to be seen especially globally, the service business, this is the aftermarket business. This is for the international business with a higher margin, the better margin. This will be the future business based on the current strong sales. So there we will earn the margin in the future. So this is 40% of the international business. So this will be an ongoing growth driver, which will be based on the current sales of the OE glassline business.
Thank you. The next question is from Deepak Nanolia from Birla Sun Life Insurance. Please. Deepak, your line is unmuted. Request you to please unmute your line and proceed.
Yeah, hello. Am I audible?
Yes.
Yeah. Good evening, sir. I had one question on your profit margin. Probably you have discussed this in the past also, but I just wanted some light on that. Your standalone margin, you had been reporting a 24-25% kind of margin since last 3 quarters, and your gross margins are into sales were somewhere around 44-45%. All of a sudden, it has increased, and I remember you had been maintaining that you would be maintaining this kind of margin in the India business. So what has happened? Something has surprised you, if commodity increase has happened, then was it not known to the management, something like that?
Yeah, that's a good question, and I'm glad that people keep track of what I say. But yes, I did believe, and I think it was more from a yearly kind of number. We still believe 20% plus is something that we can maintain as a standalone number in terms of EBITDA. There was a one-time cost of the gas price increases, which were not considered. Obviously, that has had an impact. And 2, I would say, would be the investments really that we are making in both Vatva and in Hyderabad that have kind of impacted profitability also in this quarter. But definitely there has been an impact in steel prices. Currently, we were enjoying steel prices which we had bought few quarters ago. We were consuming those, and as Manish said, that as we start consuming the newer plates, our kind of weighted average cost went up, and we saw a kind of a decrease in profitability. Now, to be honest with you, 25%, 27% EBITDA margin was obviously something that was probably not sustainable. I think around the 20% mark is something that we do aim to do. Glass lining obviously is a little bit more lucrative for us, and I think we have maintained the margins there. With the export business coming in, also we believe that glass lining will continue to improve, and we do believe that once the steel price begins to taper, you will see some improvement. So like I mentioned to you, yes, it's not a structural change in the business. It's more of a short-term impact due to material prices. I don't think we will be the only industries which are impacted by such costs. I think it is probably something that will happen across the board. Now we need to kind of really focus on how do we bring it back by looking at our own efficiency improvements. Do we have levers available? Do we have buckets available where we can start working on to make sure that internally also that we are very cost conscious?
Thank you. Ladies and gentlemen, that would be our last question for today. I now hand the conference over to the management for their closing comments. Thank you, and over to you.
Thank you, everybody, for joining us. Stay safe and look forward to speaking to you during our next investor meeting. Thank you once again, and good night.
Thank you.
Thank you very much. Thank you, ladies and gentlemen. On behalf of GMM Pfaudler Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your line.